Hello everybody, welcome to this WFA webinar. So we're going to get started now. We've got a great number of people on the line, and we're looking forward to some good content today. So welcome to this WFA webinar. Today's topic is looking at global agency remuneration and performance incentives, and it's going to be hopefully an hour of stimulating content. We've got lots of information to share with you that's come from WFA, and also delighted to have our three here with us showing some of their content as well. So just a little bit of webinar housekeeping before we begin. You should be able to access the Q&A box on the right hand side of your screen. That's where we'd like you to ask questions, and we hope there's going to be lots and lots of questions asked by you. We'll try and get round to those at the end of the webinar today, so we should have around about 10 minutes whereby we'll get round to answering all of the questions that you guys want to ask. The slides are going to be shared afterwards, so you'll get an email with the presentation and all the content that we're sharing. And we'll also make this recording available as well for anybody who wishes to access that. So you can either go straight onto our knowledge base, which you can access via our website, and that's where you can download some of the content, or we'll email that directly to you. So just let us know which you prefer, and we can make that happen for you. So we'll try and get this done within the hour or so. So for those of you on European time, that should be at 10:30. Sorry, 11:30. I apologise. And for those of you who are joining from different parts of the world, thanks very much. It's great to have you on board. I'm just going to quickly give a bit of information on WFA for those of you who aren't WFA members, and just outline a little bit what WFA is all about, and then we'll get started with the content from our three and the team there. So just by way of some quick introductions, I'm Steve Lightfoot. I lead our marketing sourcing work here at WFA. We have Natalia, who's helping with the logistics around this webinar today, and is also our knowledge manager at WFA. And we're also joined by Greg and the team at R3, and you'll hear a lot more from Greg later, and I'll let Greg introduce himself in a moment. So by way of just explaining a bit about WFA, so WFA is made up of two different types of members. We're delighted to have around about 55 national advertiser associations within our membership. Those associations stretch from China to Canada to Chile, all around the world. And we do a lot of work helping our associations get access to global marketing expertise and global knowledge, and we rely very heavily on helping our corporate members understand what's going on in those local markets, and for that we use our national advertiser associations to help us find out more about what's going on. And we're delighted to have some of those guys on the call today, so thanks for joining. In parallel, of course, we have global corporates in membership, and here you see some of our companies who are in membership. We've got around about 75 global advertisers who make up our network. Some of the newest members actually of WFA are on our webinar today, so thank you very much for joining, guys. So we have Swarovski, eBay, Volvo, Nike, and Mazda. So for those of you who are joining from those companies, thanks very much. It's great to have you participate in the webinar today. So with that, we should move directly onto the topic. And of course, agency remuneration is a topic that is extremely popular within our sourcing forum. It ranks as the #1 topic in terms of priority for our sourcing members. At the beginning of 2014, so just beginning of last year, we did a piece of work on remuneration and pulled together a guide which helps our members understand global remuneration trends. That's quite a large report, so 27 pages, goes into a lot of detail. Greg's going to be alluding to some of that later on. But that report is available for everybody. It's available in our knowledge base, it's available online, and it's available upon request. If you'd like to receive a copy of that, more than happy to provide that to you. And some of the, as I said, some of the data in that report you'll see in this webinar, but there's a lot more that we can also share with you as well if you have more interest in this topic. So with that, I should introduce our three. And we've been working, I think, close to 4 or 5 years, I think, actually, Greg, with R3. And it's a pleasure to again do another webinar with you guys. R3, for those of you who don't know, they work with many of our members, many WFA members, um, and they've been featured in meetings and led some sessions within our sourcing forum in the past. Based out of Asia and have representation and offices all around the world. Um, they focus a lot on helping companies with agency reviews, how you manage your agencies, and of course with remuneration and incentives, which is the topic today. So with that, Greg, I'll throw it over to you, and I'm sure you'll do a much better job of introducing yourself than I have. But that's broadly where we stand. But thank you very much, Greg, and we can get started.
Thanks a lot, Steve. It's great to be here, at least on the phone. I'm going to keep anything about us short. You can easily get to our website. We have a ton of information up there. But today we're just going to go through three things. One is really, how do you go about setting incentives for agencies? We've been fortunate to do this for the last 13 or 14 years across multiple countries, multiple companies. So we'll try and share some of the examples today. We've got a couple of case studies as well from Samsung and P&G, so we'll talk through a little of those. And then just finally some actions for you guys so you can get some takeaways, things you may want to work on locally. And through this whole thing, if you have any questions along the way, just shoot it up on the chat or interrupt me. It's totally fine. Just quickly on us, we're about 70 people now. For most of our clients, we're covering multiple markets around the world. We always say we're here for effectiveness with efficiency. Of course, we spend a lot of time looking at agency fees and costs, but honestly, we're trying to make the client and agency more effective working together to achieve better business results. So that's kind of our focus on the way in. We've been lucky to start with Coca-Cola 12 years ago, and they've been a client pretty much ever since, as has J&J and Samsung, and we've just started a relationship with Unilever, and so we're kind of a good cross-section of marketers. I think some of them may even be on this call. And if you're wondering what the 3 R's stand for, this is the last chart about us, but it's basically looking at the return on agencies, return on media, and return on investment. So quite often we're doing a media audit, we could be doing a marketing and investment analysis, or we could be just looking at agency relationships and remuneration. So that's it from us. I really want to get into the topic and look at setting incentives. I mean, first of all, we're going to share a little bit of cases from the WFA. So, this is a recent study from last year, trying to look at the baseline first. So how do different members currently pay their multiple agencies? And we're going to break this down in a minute, but you can see there's roughly half of the relationships now are on labor-based fee. When we started 12 or 13 years ago, over half were on commission. So it's been quite a major change in the last 10 or 15 years. I think you're going to see that black area increase, which is kind of a fixed or output-based fee, also a project-based fee. I think more and more marketers are working on shorter and shorter relationships with their agencies. So it's going to be interesting to see the changes over time. And these data is for the global marketers, by the way. So it covers Europe, Asia, and the US. So when you break that down, you can see it changes quite a lot by type of agency. You've still got a good chunk of media agencies, roughly about 30%, that are still working on a commission basis with their agencies. I guess 50% when you include some of the variable areas in there as well. That's slowly changing for some marketers, but others are quite happy working on a media commission. Again, we'll talk a little bit later about the pros and cons of each way. But you can see some big changes by agency type there, so that's quite significant as you come to look at the different agencies. And yeah, the labor-based fee is a retainer model. That's how it's been allocated under here. I think the other interesting change is now the important role of procurement. You can see in half the relationships they're taking the lead, or 62% of relationships they're taking the lead. And really only in 6% of members is marketing working on their own. So definitely the role of procurement is well and truly entrenched in terms of working with the agencies on their compensation. There you can see the difference. So it's definitely increasing as well. Now this one is, sorry about the carrots, but this is from a US study. And you can see now in the US that 61% of marketers are using a performance incentive. So that's increased quite a lot over the years. You can see the gradual increase there. And then when you cut that by top marketers, so those spending over 100 million US dollars, it's roughly around above 80%. So incentives are here to stay. It's really a matter now of how do we work with them and how do we optimize them. So that's really the purpose of what we're talking today. And chart 11 is so blindingly simple and embarrassing, but to be honest with you, these are really the three key buckets for any type of agency relationship: the performance of the advertiser, the advertising, and the agency. Now, of course, that will vary depending on the type of agency, but generally, those are the three key KPIs that we tend to look at. The advertiser usually being a sales or market share objective, the advertising usually being something you can track through a research partner or some other method, and then the agency is either an agency evaluation or some kind of media audit or some other audit we'll get onto. But those are literally the three buckets that we see for almost every type of agency we work with. So we try to put all that in one chart. Sorry, the design format's gone off a little bit there, but you get the idea of creative media, digital, social, and events. Five very different types of agencies. But generally, we are seeing similar areas across all of those areas. So you can see for the creative agency, a lot of marketers, especially FMCG marketers, are using Link, which is a Millward Brown research methodology, is one of the criteria. Any kind of brand equity tracking that's in place is also very valuable in this area. For media, we are seeing some look at advertising awareness and recall as an option. Digital, still quite new, but we'll come on to some of the KPIs later. And then social, very much about setting specific KPIs around social. And we've included events here. We've had a lot of experience recently working on a lot of event audits and event benchmarking. And quite frankly, we think it's kind of a neglected area amongst marketers. It's often for auto and IT companies, it's a very huge expense and an area with a lot of potential improvement in the way it's managed. So if you look at how that breaks down, and I should warn everybody that this data varies a lot. For a fast food company, the weight on advertiser will be much more significant. It may be as high as 40-50% for a retail company, or somewhere where advertising has a very direct linkage to sales. The advertiser component will increase a lot. And I'm sure you'll find on the left-hand column there, a lot of agencies will have challenges being linked to your business results. But at the end of the day, it's a small component. It's usually 10, 20, 30%. And truthfully, if the company does well, that should be a precursor for the agency doing well. The second bucket you can see varies a little bit depending on the type of agency as well. These are averages. Obviously, as we said, it depends on the type of agency. But definitely you could see for media, where you have things like media audits as well as evaluations, they're taking up a far more larger share of the overall incentive. So what I'm going to do in the next section, by the way, is just show a little bit of these KPIs in detail. So thanks for the questions, but that's really the next part of this. So I think just one thing on creative, we've noticed a lot of marketers are now moving from a retainer-based relationship to a project-based relationship, and we see this as a challenging trend because in our experience, agencies tend to mark up the relationship when it's on a project basis, and we're trying to urge our clients to at least look at some kind of baseline retainer, even if it's just on the basics of scope of work. and projects can be allocated later. But at least try to look at a different model, because you can see here in this case, you know, areas can be as high as 10, 20, 30% more than the actual retainer base to work on creative agency fees. When it comes to media agency KPIs, there are a lot of these. You can see here there's a click on a downloadable white paper we have, which goes into these in a lot more detail. But it's generally done both on year-on-year cost and also done on cost versus external benchmark. We're seeing a lot of challenges with inflation. More and more marketers are having to deal with inflation, particularly in developing markets of Eastern Europe and Asia. We obviously urge people to look at different factors, including things like savings versus rate cards. So, we can probably have a whole separate session on media metrics, but honestly, the key thing is to set up the right criteria that matter for you, and then try and evaluate them. And I think our biggest challenge is to urge marketers to also have a good balance of quality metrics when it comes to media. There's been a lot of push for agencies to be driving costs down, but at the end of the day, you still need to get good quality airtime with the right primetime performance, the right positions in break, the most appropriate programs and selection for your target audience. So you really have to strike a good balance between qualitative and quantitative on the key media metrics. When it comes to digital, there's a whole bunch of display metrics, and then in a minute we'll get to social as well. Again, these are in the white paper that can be downloaded. But increasingly for digital, we're seeing people moving away from some of the basic cost ratios and looking more at engagement. So trying to do some kind of independent research to track the actual consumer engagement online, whether the campaign has been remembered, and whether there is a strong recall. So again, look at a bundled group of metrics when it comes to setting the right criteria for KPIs. You could definitely ask your agency, but you should also look at other sources of that information as well, because you don't want the bar to be set so low that the agency is not challenged to get over it. Common feedback we're getting right now too is the cost of digital agencies. There's this period where many marketers are kind of new to the intricacies of digital, and some agencies are taking advantage of this versus others. And I think you really need to dig into the cost in detail as to whether it's because you're paying by rate card, again, because you're paying by project. Well, the factor that we see mostly is more about fees for digital production. For a typical advertising agency, production costs are always handled separately as a separate pass-through cost. In the case of a digital agency, a lot of that production is done in-house, so it makes the final sticker shock a little higher because of the way that digital agencies manage a lot of that internally. Again, you need to really have a more apples-to-apples comparison so that you can actually look at traditional agencies with their production and compare that to digital agencies with their production as well. We're also seeing a lot of marketers using multiple digital agencies for similar services, and also relying on their digital agency for strategic services when that may be better served through a lead agency model or some other model. So again, just try to avoid the duplication of having multiple agencies playing the role of strategic leadership, and have them focus on what they're strong at and good at. And then of course the last factor, which I definitely won't dwell on this call, is just the whole aspect of transparency, which is something that you need to keep quite vigilant about. So we have a poll here. I'm going to just turn that over to Steve to get some votes. We just want to get a sense of, particularly on media and digital incentives, the challenge always is to know what the final baseline is from these agencies. So we're trying to get a sense of where members may sit in this area. Steve?
Yeah, absolutely. So you guys should be seeing, yeah, I'll take it over. So you guys should be seeing just a quick poll that we're going to run just to see how people perceive this online, so you can vote straight away. So we're just looking at media and digital incentives. just to get a sense for how you guys do them. So a few options there. So we don't do them at all. We don't really know how much revenue the agencies actually make. We think we know how much revenue the agencies make, and we're sure we know how much revenue agencies are actually getting. Um, so those results are coming in now. I think Natalia, if you can share those results back with everyone. I think this is probably indicative of generally how the industry perceives this. This doesn't necessarily surprise me. Um, the majority of people saying that we think we've got some visibility on how agencies are actually making their money, but we're not entirely sure. And I think that kind of doubt is certainly manifests itself in the current discussions around transparency that are playing out in the US, and have played out in Europe and elsewhere for perhaps a little longer. But that certainly
Mm.
is indicative of where the market is right now, Greg.
Yeah, I think that's pretty clear. I mean, I think that the challenge with this is, if you're spending all your time on the right KPIs for your agency, but you're not even sure of the baseline, you really need to be sure of both. So, our view is that agencies need to be paid very, very well, but in a very transparent manner. So, understanding if they achieve results, obviously, understanding that baseline is very important to then factor in the right KPIs on top. So just a little bit on social. I think a lot of marketers are now, undecided on how to actually set up their social relationships. Mondelez is experimenting with hiring writers internally in their marketing teams. Others are setting up newsrooms like Adidas and Intel. So it's really, an open platform at the moment in terms of what's the right structure. But these are some of the key metrics that we're seeing. Being tracked from the social agency. Again, try to get as much predictability and quantitative and benchmarking up front on these, so you have a good platform to work from. But the main thing is that social agencies need to be measured and rewarded in much the same way that others do. So that needs to be very transparent. And I'll just touch briefly on event agencies. I'm happy to send offline to anyone who wants it some event KPIs. But I mean, we're seeing marketers like Microsoft now invest as much as 50% of their budget on events. So you really need to have that diligence and accountability for the agency. And definitely you need an upside. So I mean, the event agencies have historically been paid on a project fee, which has been pretty flat for an event. Our belief is there should be a variable amount in there based on results, and that's something that's quite important. The one thing we don't have a specific chart on is the amount for a KPI. It really depends a lot on your company and your tolerance for pain and your tolerance for paying the agency. Best practice for us is typically a plus or minus 10 or 15%. So if the baseline fee is $100, an agency may earn as low as $85 or may earn as much as $115 based on results. But that tends to be the variable amount. Some marketers push it further, some marketers push it less, but 15% up or down is probably about the average. And again, it's really about how easy can you pay the bonus should the agency have it. A lot of marketers have trouble keeping that money as a line item within their marketing fund. And I guess that the bottom line is it just needs to be as transparent as possible so that and the agency knows how you're progressing and how that's likely to come out at the end of the year. So we're going to talk a little bit now about putting all that together because increasingly now we're working in a multi-agency world. The days of Mad Men are over. So before we do though, just a quick summary on where you guys are overall in terms of incentives and try to understand the role of integration in those incentives.
Yeah, so Greg, I'll pick that one up. So, in terms of where you guys sit in terms of paying your agency bonuses and incentives, so performance-based models, let's just have a quick virtual show of hands. I'm predicting here that we're gonna see most people using them in some form. But here are the options. So we don't do incentives at all. We do them for our main agencies only. We do them for all of our agencies, and we do them, but it reflects our integration approach and how we're managing integrated marketing communications. So those results are coming in now. I'm actually a little bit surprised by what I'm seeing there, but we'll share those results back with you. So Natalia, if you can share those results back with everybody as they currently stand. So we'll see there that actually most people are saying that we only do them for our main agencies. I guess there, Greg, I mean, I suppose it depends a bit on your definition of main, but
Yeah,
you know, the
yeah.
companies that we've got in membership, they're obviously working with some agencies they have an enormous amount of business with. It's kind of, you know, sort of 80-20 in terms of sort of the spend split.
Mm,
They've got much more with the main agencies versus smaller agencies. And it's definitely true that when you're spending less with an agency, using KPIs becomes less interesting because the percentage upside is perhaps
yeah.
too small for the agency to really get much out of it. So perhaps that's not too surprising. But there, I suppose it does depend a lot on the size of the agency, right, in terms of the incentives that you're giving them. But members there saying around about
Yes.
70% of members saying that they only use those with their main agencies and not the smaller ones.
Yeah. Okay. Great. Yeah, so I think we're in a market where there's a lot of turmoil right now. You can see many different agency models coming out. WPP starting a separate agency for Colgate. Jaguar Land Rover recently took all of their direct marketing and digital business in-house. So many changes and many different issues going on. With that in mind, we published something this week or last week called Integration 40. We tried to look at the best campaigns from around the world in the last year, and very much about the process of how they got the work done, rather than just the creative ideas. So, we're happy to send a copy of those to any members who want a copy. But I'm going to take you through some of the top lines now of what came out of that. We looked at hundreds of campaigns from 6 continents, and we basically looked at what we call 6 degrees of integration. We identified 6 different ways of marketers working with their agencies right now, and this one was most common in about 30% of cases. I'm sure a lot of your members are on this structure already, where you have multiple agencies, creative, media, digital, etc. It gives you a lot of flexibility, obviously. It helps you get the best-in-class talent. But it does put a huge burden on the client management, and several clients now have a very large team internally just to manage agency integration. So that's kind of the most common model. But we'll show you 5 of the others that also came out of that. The second one is what's called a lead agency model, where the lead agency can even go as far as to actually pay and recruit some of the other agencies. Certainly, P&G have tried this over the year on different brands with different amounts of success and failure, but it's something they're still looking at. Huawei, which is a Chinese telecom, is also trying this model. So again, it's a slightly different twist on the current model. The pressure is pushed more back to the lead agency to drive integration, and there are again pros and cons with this. And we saw this in about 15% of the cases that we studied. The third model is increasing more and more recently. It's kind of a holding company model where you use separate agencies but under a holding company structure. So Visa, for example, have all their business within Omnicom. HSBC have all their business within WPP. So it doesn't mean there's necessarily a large holding company support group, but definitely there is a presence there, and then an involvement, and then the individual agencies work from that. So we're showing all these because all of these affect the actual incentive structure and the way you put an incentive together, depending on the type of integrated model you have. Under this model, you may even award an extra bonus to the holding company for proving that they can manage things seamlessly on a global basis or a regional basis. We've seen that in several cases. And kind of a spin on that model is this idea of a standalone agency. So right now, Apple, for example, globally work through an agency called Media Arts Network. It's a separate unit within Omnicom, and they only work on Apple. Ford have an agency globally called Blue Hive. It's part of the WPP group, but it's 100% dedicated to Ford. So again, there are pros and cons with this model. It's definitely something only for the larger advertisers where you have real scale and the ability to bring a large team together. There's definitely a lot of value in terms of getting efficiency of work out. You're managing 100% of everyone's time. But the challenge is then bringing in the great creative talent to really cut through with effective advertising. And that's been one of the big challenges with the model. Again, this will change the way the incentive gets structured if you have a single agency model in this sense. And I think we're going to see more and more of this fifth one, which is called free agent. Right now, Sony is very much working on this model. Intel has been working on this way in the past. It's basically having a very large roster of agencies. Sony has around 9 creative agencies, and they, on a project-by-project basis, will pass out work as appropriate. So this makes the incentive structure more of a project-based one. It gives the marketer a lot of flexibility, but the challenge we've seen with it is, the agency tends to play more of a tactical role than a strategic role. So you really need to decide how you want your agency to connect with you. We saw this in 5 or 6% of the cases, so it's not very common, but it's definitely something that's being done in some cases. And the final degree of integration is kind of the cobweb model here of a single agency client relationship where media and digital and creative is all done in-house. It's very common in Brazil, in Japan and Korea, and common really for small marketers where they'll likely hire a jack of all trades small agency. So we saw this in a few cases, but it's not something we see consistent on a global basis. And really on the next chart, you can see how those 6 different models played out. And again, the way the incentive structures are put together is different for all of them. It's only a base of 40 relationships, but you can see that BBDO and Omnicom and Dentsu are the ones that really came out as leading the way in a lot of these cases, closely followed by WPP and some of the other agency groups. So just 3 quick case studies on incentives and the way they work. And and as I work through this, I would probably suggest incentive may be the wrong word because we're not suggesting agencies get paid more. I guess the best word is really accountability. It's really about paying the agency more or less based on their results, and that's kind of the key criteria for all of this. The first one we really can't talk much about. It's still very much in progress, but Unilever out of London, an agency, a company with 120-year-old relationships with JWT and very long-term relationships with Ogilvy and Lowe and DDB and others, are really trying to look at the way they're paying their agencies and how they can actually move from a very much a cost-based to a value-based and pay based on outcome, pay based on the results that the creative work is being driven. And so it's really too early to get into detail on this, but it's essentially on chart 35 about, do you choose to pay the agency very little bonus or do you choose to pay the agency a very large bonus? And for any marketer, it's about finding the right point on that continuum to how much of the fee can be variable and what are the criteria under which you'll assess it. The other example on streamlining, which also affected agency outcome, is P&G. 6 or 7 years ago, this was P&G's model of multiple client stakeholders dealing with multiple agencies, trying to create a single advertising message. And it proved to be very, very inefficient within P&G in the way they were working. No one was really in charge, and there was a lot of duplication through the whole process. A little bit like this picture here. So what they did is two things. Obviously, they came up with the brand agency leader approach, which they're using on a number of their brands right now, where a single agency, usually it's a creative agency, it's usually Saatchi and Saatchi, Leo Burnett, Gray, or Publicis, will take the lead on a brand, and they will then manage the relationships with the media agency, digital agency, PR, and event agency. And but more importantly is the change on the client side. So those 4 or 5 individuals in P&G came down to one single decision maker for each brand, who had the ability to decide whether to go or not go on the communication message. So it's all very well to push your agencies to be more streamlined. You also need to look internally at what's the best model for us to be more efficient and effective going forward. And the last one is one that we led last year for Samsung. Samsung really wanted to drive greater creativity and a greater digital capability on a global basis. They've been suffering over the last year with Apple, so they conducted a very thorough review across all of their markets, and they basically ended up with 4 types of agencies now, which is a little unusual. But they ended up with a network agency, Jail and Leo Burnett. But they also brought on White and Kennedy and BBH to give themselves a good choice of boutique creative talent. A lot of very fast turnaround work in the technology sector. They need the flexibility of the best creative agencies in the world, and that's one of the things they did through this review. They also brought on 2 more digital agencies than they had before, and they maintained Starcom as their global media agency. Why we're showing this case is really how Samsung now evaluate their relationships, and they do basically 3 levels. So of course they have each of their clients, each of the marketers around the world, evaluate each of the relationships. They also have the agency evaluate them. But interestingly, they have the agency evaluate other agencies. So Starcom will be talking about Leo Burnett and Shale. Shale will be talking about the digital agencies. It's really about how can the other agencies collaborate better, which are the ones that are doing the best job, and therefore some of the incentive will relate to the way agencies evaluate each other, and not just how Samsung evaluates the agencies. And we're seeing that that's really the key thing for integration, is to prove that agencies are good partners and very effective working together. That's a criteria that we're seeing included now in some of the KPIs. So I guess just wrapping up and then a chance for question time. I think 4 basic things. I think there's been a lot of talk in the industry about value-based and people being paid on their intellectual property. That's a very big challenge. And so we're actually encouraging marketers to move from the theoretical concept of being paid on intellectual property to the practical concept of being paid on outcome. So being paid based on the results of a campaign or a year's relationship. The second thing is really to push the criteria as much as you can. Agencies that have a high reward factor will tend to bring on their best creative talent and their best people, so that they can optimize that. So it's in your own interest to really drive the variable amount as much as possible. The third thing is about trying to measure and prove the value and cost improvement of integration. It's really a matter of looking at what can we take out that's not going to impact on the overall outcome, that's going to help drive things more efficiently and effectively. That's going to have a huge impact on your agency fees as well as the incentives. And finally, digital and social needs to be at the center, not just as an add-on. Digital is no longer a division of a communication platform. It's very much central to the whole campaign. So that's really the crux of it. We're obviously happy to take follow-ups and share whatever else we can along the way.
Great
Steve, I
stuff.
guess
Thank
over
you,
to you.
Greg. Yeah, brilliant. So everyone, thanks for your questions. Thanks for putting those in the Q&A box. Feel free to add in any as we go along now. So we're going to take just in the last kind of 10 minutes or so, we're just going to take those questions and pose a few to Greg. Greg, I'm going to dive right in if that's okay. So, just one question in relation to clients committing to measuring agencies with hard metrics. Have you seen some examples of clients who have really basically picked those metrics which you might consider to be a bit harder in terms of the business metrics, whether they're sort of linked to market or brand share
Mm,
or sales volume or the likes of brand equity, even those things that you can really actually measure and do have a tangible
yeah.
financial component to them. Have you seen clients really commit to those in terms of the metrics, and have you seen agencies actually respond as well? Because obviously the standard cry from agencies is, oh well, if you're selling ice cream and it rains in the summer, then we're not going to sell as much ice cream, irrespective of whether the creative was good or not, or we
Mm.
bought the right media. So have you seen agencies really commit to those hard metrics?
Well, yeah, I mean, a couple of great examples, one of which is Dell. I mean, Dell very much, Dell's never had any physical stores. They've relied on advertising as a key driver. Every individual Dell ad comes with a different phone number or URL, so it's very easy to track in great detail the performance of each ad. So, they've very much driven their agency around that model. The agency's even been proactive to sort of predict the sales results of Dell based on historical data. So, that's an example, I guess, where they're sort of joined at the hip quite closely. P&G in the past, by the way, also experimented with a sales commission for their agency. They paid their agencies as much as 1 or 2% of sales, depending on the brand. But they've since moved away from that. But yeah, it's always a tough discussion to have the agency linked to sales, but it's really depends on how relatable the agency activity is to sales. Obviously, in the world of e-commerce, it's going to be closer and closer than ever before.
Great. So I'm just going to crack on with one slightly theoretical question. This is maybe a little bit provocative, but let's go anyway. Do you think that VBC has a future? It's not popular with agencies, and it's very time consuming to implement, both for agencies and clients. That's an interesting one. I mean, I think um, let me weigh in before you respond to that, Greg. I think it's interesting that outcome-based models are certainly more popular than they were. I think VBC is obviously kind of famously been championed by Coca-Cola, and there's other companies who've implemented a version of which is quite similar to VBC. But certainly outcome-based models are more popular, and I think there's certainly a point about keeping it simple with regards to the agencies. But what do you think, Greg? What's from your experience and having worked on lots of
Yeah,
different models?
yeah. I mean, it's a very hot topic right now. I think the main thing is to try and move it from, as we said, from theoretical to practical. The agencies are saying things like, well, hey, we helped create this Apple brand, which is now a $700 billion company. How do we get an equity share, or how do we get an intellectual property share of this, right? So those sort of discussions are very tough to have a transparent debate about. But marketers have a lot of history of how much things cost, and that can be used as a good basis to move to a value-based system. Because the focus needs to be on the incentives and outcomes, not on the number of hours. I mean, we're in a market where the slower people work, the more they get paid. That's not a very viable business model for agencies. So we need to really look hard at finding a more effective one.
Great stuff. So then, one question that's come in as well. How do you ensure a fair evaluation across agencies? What can you do? What can a client do to ensure that the agencies that is actually being assessed transparently, and that agencies don't feel that there's sort of unfair bias going on, perhaps to um, relationships that have been in existence, as you say, for in some cases over 100 years is quite an unusual amount of time, but
Yeah.
but certainly some of those long-standing relationships do exist. How do you ensure a fair evaluation then across your agency roster?
Well, yeah, I mean, we link, I mean, agency evaluation is a little bit like staff evaluation. If you've got a procurement executive or a marketing executive, you've got to give them the same type of transparent and professional evaluation so that they know where to improve and know how to move forward. So, I think one of the things is to try and make it as mechanical as possible. So, in other words, in advance through the year, agree the sales, the brand equity, the media audit results very, very transparently. So, an agency can track through the year how they're doing. And so, obviously, there'll be a qualitative element when the marketer evaluates them, but there'll also be very clear guidelines on where they stand on everything else.
Okay, Greg. So one question then around, I guess it's a question about the P&G and Samsung cases, and I'm aware you can't go into sort of too much detail on them, but it's a question which is a bit broader, and it's really around sort of how does central work with local in this case, because obviously there's central teams trying to roll out global strategies, there's local markets who are actually doing
Mm.
a lot of work in terms of implementation or adaptations, or indeed if the brands are kind of local in some cases, then they're actually leading that work on those brands. But yet there may be a global strategy which a central team is trying to implement. How, maybe sort of thinking to the P&G examples and the Samsung examples, how does that sort of dynamic work together when you're trying to implement either a new model, or if you're trying to conduct those assessments?
Yeah, I mean, I think there's two kind of corny phrases we use. One is, there's no such thing as a local market. There's only a lead market. So it's really a matter of looking at all the work done locally and seeing what can be cascaded later. Some marketers do that very, very well through intranets and through sharing and so on. Others not so well. And then the other phrase on that is just, it's not just about create, it's also about curate. So it's also about, again, where can you take things from other places and, curate them or use them in a more constructive way. With the growth of digital and social, there's so much content needed now to complete a marketing campaign. It's very difficult for every market to keep reinventing that on a local basis. So it's really setting up both offline and online structures to share what's been done better and then look for commonalities and ways of streamlining.
Greg, one question then around, you sort of touched on this in terms of not mentioning numbers in terms of bonuses and malices and things, but there is a
Mm.
question that's come through around that. So, how internally, and I'm rephrasing it, so bear with me. So, how does a client then, if it is very difficult to understand what the upside and the downside, the sort of the bonus, the malus, the upper and the lower threshold that you're actually awarding to an agency is, if it's very hard for a client to sort of to actually get a number based on what other people have done, how does a client actually understand and push internally for that right amount? How do you actually set that? Obviously, it's conversations with finance. Obviously, it's conversations between um,
Yep.
between marketing, between procurement and finance teams. But how does that work? And what is a number that could be arrived at? In the past, we've heard that from some agencies that it's not worth working for anything that's less than 20%. But then if you set that as a benchmark, there will be agencies who can undercut that. Coca-Cola famously, sort of going up to sort of 30% in some cases. But what
Yep.
do you feel to be sort of the way that this is going?
Yeah, it's a very detailed and sensitive discussion. We're still seeing a lot of marketers, with a 5% upside. I mean, if someone was to pay you, 2 weeks extra salary for a year's work, it's not a very motivating factor. So, you need to have something variable enough to make it worthwhile for both sides. And likewise, if the agency underperforms, there needs to be some respite there. So it's always a challenging discussion. I think again, it comes to a lot of risk tolerance on both sides. But there definitely needs to be some debate about what's the right platform. I think anything less than 10%, honestly, sometimes the workload involved in simply managing that isn't even worth the final incentive number. So at least be cognizant of that. But you also need to make sure you've got the right baseline and you know what the agency's likely top line profit will be and bottom line profit will be. So it's not just about a bonus on top of 15% profit margin. It's actually about holding the agency accountable for their work.
And then maybe just one final question, Greg, before we wrap it up. Um, you've obviously got a lot of experience being based in Asia and having sort of worked with a lot of Asia-based companies and companies who've got a big business represented by a lot of those markets. Do you find that in Asia, clients and agencies are more ambitious in terms of the models they're using, maybe in terms of profit share models or shared risk and reward. Um, we've seen in some of the research we've done that that shared risk and reward model where an agency puts a percentage of their margin at risk and the advertiser meets or exceeds that as a percentage as a potential reward. That those models are increasingly popular. Um, and I'm just wondering if that's something that you see more in Asia, where perhaps there's more people are willing to perhaps put a little bit more skin in the game than elsewhere.
Yeah, I think it's a good question. I think I'd say yes. I mean, because you're also seeing a lot of markets where there's a lot of double-digit growth, so agencies are prepared to risk more. But to be honest with you, we see more difference between multinational agencies and independent agencies. Agencies that are owned by holding groups and are on a quarterly profit earning are less likely to come
Yeah.
up with something dramatically variable. Individual, independently owned. If you're talking to the owner of an agency, he's far more likely to come up with agree to something more radical. So that's again back to the event agency scenario where you've got these independent agencies. You can come up with something a little more radical than you can with a holding company.
Good stuff. Okay, Greg, thanks very much for that. It's brilliant. So we're going to feature this remuneration discussion, of course, throughout 2015, and it's going to be back on our agenda for meetings in certainly in Q3 and I think also in Q4 when we do our meetings in Singapore and also in New York and in the European Union as well. So remuneration is obviously something which is a very interesting topic for many people, and it's something which you can't really cover off in an hour. But thank you very much, Greg. I think that's a really good snapshot of current trends. We'll be doing some more work with R3 later in this year, in particular around this topic of incentives and how they can be structured. So please do look out for that. If you wish to reach out to Greg, then we'll share Greg's details with and the R3 team's details when we send out these slides. So you'll be able to reach out and speak to Greg directly there. If you'd like to have these view the webinar, we'll have it available in our online knowledge library, so our global knowledge base, which you can access via our website. That will be up very shortly. If you don't have a password or a login to access that, then just drop me an email or drop Natalia an email or get in touch via the website, and we'll make sure that you've got a password to access that. That's free for WFA members. That's something that's part of your membership fee. Our next meeting of the sourcing forum is going to be on the 20th of May. That's taking place at Shell. Thank you very much, Shell, for hosting that in London. So we'd be delighted to see as many of you there as possible. The agenda for that is going out very shortly, but I think we've sent out a save the date, so I think many of you will have seen that. And that's it from me, really. So thank you very much to Greg again. Thank you for the whole to the whole R3 team for putting this together. Thanks for all of you joining. It's been a very popular webinar. We've had loads of people on, and we'll be in touch very, very shortly. So thanks very much to everyone, and have a great day.